The Federal Reserve is hinting that it's ready to lower interest rates, but just not yet. The Fed held the benchmark rate steady for the 8th month in a row, and the chair says, Jerome Powell, central banks paying close attention now to its dual mandate, stable prices and low unemployment. Now, he points out that the pace of job growth has moderated and is now starting to look at the rate of unemployment. Both will be up for discussion in September.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. We're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it.
Mohamed El-Erian, president of Queen's College, Cambridge. So the question is the time right in September? A yes or a no will do, sir?
Yes, absolutely. He should have done it today.
Ah, well, yes, but coulda, shoulda, woulda. But I mean, it would be very difficult now, wouldn't it? Very difficult for them not to cut. In the absence of some truly dreadful data that comes out, they have set their stall out.
Yes, normally it would be very difficult to cut for three reasons. One is the inflation picture has improved. Two is the economy is weakening. And three is that he did not push back against September. He leaned into it. So you would need to get really horrific numbers for him not to cut in September.
So let's say they cut in September. Do we have a bit of a cautionary tale from Europe where the ECB has cut, inflation has ticked up, and we've seen a similar sort of thing from the Bank of Canada, where again cuts have been led by upticks in inflation, and there's an argument that would say the same would be, in an economy that is actually very active like the US, the same could happen here.
It could, and today we got a number out of Europe that showed inflation went up from 2.5 to 2.6%. It could, but Richard, it's a balance of risk right now. And I think the bigger risk, and more people are agreeing on this, is that the economy will weaken unnecessarily if they do not cut. So yes, there is a risk that inflation could go up, but the bigger risk is that if they're not careful, the US economic exceptionalism that has benefited so many goes out the window because they're too tight for too long.
There is a risk. I mean, there's always a risk. There's a risk that I'll trip over my shoelaces going out of this studio and do myself a nasty injury. But in terms of the risk, there's a risk that they cut in September and probably once or twice more before the end of the year. But it's not enough to offset that slowdown to which you refer. But it is enough to just sort of boost it or at least prevent inflation coming further down.
Yes. And I would put that risk at about 35%. So yes, the risk is there. Look, what you want to avoid is what you're hearing from the companies, whether it's PepsiCo, whether it's Starbucks, whether it's McDonald's, they're all giving you the same message, that the consumer is weakening. The low-income households in particular are under significant pressure. Credit card balances are high. Pandemic savings have been run down. And if you weaken the labor market, that's the only thing keeping the economy going right now for that segment of the population. So that's what you want to avoid.
The market, we are seeing, I mean, all right, so NVIDIA, et cetera, has done extremely well. And there's a bit of ferocity in terms of the way it's coming down. Do you see this rotation continuing? But at the end of the day, I mean, the future is AI. The future is these productivity gains. Is this just a temporary blip?
No. So I think there are three drivers of this market. One is that AI is real, and it is, like you say, a significant contributor to future productivity. I think that is a real phenomenon. Two is that the US exceptionals will continue. That's why you've seen the rotation. That's why you've seen the Russell do so well, best month of the year, at a time when the NASDAQ was having the worst month of the year. So that's been quite a rotation. And then the third element is confidence that the Fed will loosen policy. So as long as those three things are in play, then you can get both the AI story continuing and also the rotation story. But the US economic exceptionalism, avoiding a recession, is really important to the story.
To take that answer and sort of put it into strategy, there is no need, if all those three criteria are met, there is no need for panic or concern about, if you will, the strength of this market. Yeah, we may have a 10% correction, whatever. We may have a bit of turbulence, but the core is solid.
Correct, and that's why avoiding a new policy mistake is so important, because the core of the economy is relatively solid, the core of the markets is solid, and what would undermine both in a serious manner is the Fed remaining too tight for too long.
Not in a party political sense, but as you look at both Kamala Harris's agenda and you look at Donald Trump's agenda, I'll give you a nice anonymous anodyne question. All right, you can take it any way you like, upside down, or avoid it and plead the fifth. What are your concerns?
So I think the biggest difference between the two, Richard, is what they are talking about on tariffs on trade. President Trump has a much more aggressive stance than Vice President Harris on that. So that, I think, is where the major difference is. Against that, there's a view that Trump would be better for deregulation. So the market isn't betting on either side. It's really interesting because they're saying at the end of the day, there's pros, there's cons. So the market is simply waiting to see how this election is going to go.
Finally, I read Chair Powell's comments. We see no politics, we hear no politics, we are just data dependent. Come on, they sit around the table. Even if they don't overtly say it, they've got in the back of their mind that there is an election within 2 months and it's a bitter, bitter election. How do they avoid not doing it?
So if you listened carefully what he said all that you said. He said, of course, we do scenario analyses. You know, the scenario analyses are the what ifs. What if President Trump wins? What if Vice President Harris wins? So they may not be putting it in their baseline. They may not be forming policy on that basis, but they are running scenario analyses, trying to figure out which way the economy would go depending on who would win. But they're not betting on a particular outcome.
And just before I love you and leave you, September, done deal. You think rates going down? Just to be clear.
Yeah, yes, and if they don't, then we'll be talking about a policy mistake, and we don't need one right now.
Good to see you, sir. I'm very grateful, as always, you've given us the time. Thank you. Good to see you. Keep well.
Thank you.